Rakshit Ranjan is also joining us from Marcellus. Rakshit is a pure fundamental and a very conservative fund manager. Rakshit, I'm sure you're not excited looking at the screen. The trading community is, and your big smile on your face actually tells the story. In times of exuberance, you are the one, or your category. I know a lot of friends, and of course, we've been speaking for a long time. You behave in a much more calm manner. When the markets fall badly, thrashing happens in the market. That is what excites you. So, are you excited right now, or you are calmly observing?
Good afternoon, and thanks for an interesting question to begin with. Look, there are pockets in the market, particularly I would say quality growth stocks, where whilst the market hasn't fallen, there's a massive disconnect between the fundamentals and the share prices of some of these quality growth stocks. So that's the biggest area of excitement. That's pretty much the biggest area of exposure for our funds. And if you look at the recently reported results, I think there's a marked difference between, say, quality banks versus not so high quality banks, quality IT companies versus the others. And over the next 1.5 months, as the results keep getting reported, what you'll see is results reflecting lack of noise of COVID, lack of noise of commodity price going up and down. And this will particularly amplify from the June quarter onwards, because there's a little bit of noise in the fourth quarter FY22 as a base for the fourth quarter FY23 results being reported this time. But as the noise goes away, the commodity prices, the COVID-related, Omicron-related, or many of the outcomes of capital allocation decisions done by quality growth companies, the jaw opening in terms of fundamentals should, I think, drive the share prices, and hence that's where we are most excited about.
Okay, hi there, afternoon. Rajat, just wanted to get straight to it and get in your take as to what exactly, it is that's looking appealing to you, Rakshit, at the current juncture when it comes to the broader markets. Have there been any recent additions in the portfolio? If you could even revisit some of the names for the benefit of our viewers that you all own?
Yeah, I mean, there's been more of rebalancing of allocations wherever the share price corrections were far greater than otherwise elsewhere in the portfolio. But in terms of recent additions, so for instance, one of the pharma companies, Divi's Labs, it was part of only one of Marcellus's portfolios, and we've added it to another of Marcellus's portfolios. So we're quite positive, optimistic on that one. And that was about a month and a half ago. But largely speaking, in the last 12 months, we've tried to capitalize on more opportunities to benefit from rebalancing activity rather than massive entries and exits in the portfolio.
All right. Request you to just stay on with us. We're going to slip into a very quick break, but don't go anywhere. Lots more stocks that we'll be discussing with our guests as we wrap up the last half hour of trade.
Ranjan is still in conversation with us. Rakshit, I want to discuss a pocket which you understand very well, and the stock prices I'm talking about is only for reference. You added Divi's some time back, and I remember at that time the entire analyst community was pretty surprised. But look at how last 6 months have been for Divi's. After making a bottom of around 2,800, it's at around 32.65 right now. It has been rising steadily. Yesterday, Laurus came out with the numbers, though numbers are overall nothing great, but the API part of the number did very well, and so did Glenmark Life. Are your thoughts in that direction, that API, the worst for API type of businesses, and then of course because Divi is the leader there, that shadow of correction is getting over for that business category?
Sorry, our conviction on Divi's is more from a stock specific perspective rather than from a category oriented perspective. So from a stock specific perspective, Divi's is a firm where actually half of its business is not API related. It's a contract manufacturing of patented molecules largely, etc. And as a result of this part of the business, there tends to be a lot of volatility from quarter to quarter in reported results because certain contracts, they expire, others get added, and the timing differential between the two types of contracts, expiries and additions, it causes volatility. Typically, what we've seen historically is with this volatility, the share price also tends to be very volatile. So till about a year and a half ago, when Divi's share price had reached very high levels, we had been reducing our allocation to Divi's in the portfolios. And once the share price corrected about a year ago, we did a lot of, about 6 months ago, we did a lot of checks at the ground level to understand the global dynamics of the big pharma and their sort of relationship with Divi's, how it has been evolving, etc. And that's where the company-specific aspects kicked in to our conviction, and hence we decided to add. So it's more company-specific here. Although having said that, I mean, as I said, in general, quality-oriented businesses which have done significant investments in the last 2 to 3 years to benefit from the COVID event as a crisis or Russia-Ukraine event as a crisis, they'll all see the benefits of those investments, accelerated investments in the next 12 to 24 months. So whilst we don't know and cover some of the stocks that you mentioned, Divi's is a stock-specific call.
Rakshit, do you have researched the area of consumer durables, particularly air conditioners? Because Voltas has been a massive underperformer. This time around, despite of a worse heat wave, the stock didn't do very well, and perhaps got to do with the numbers also on the weaker side. But I want to understand, there is so much competition coming in. Earlier, there were just two top companies, Voltas and Blue Star. Now there is Daikin. There is Havells has acquired and turned around Lloyds. Panasonic is there. There are so many, half a dozen companies, and people have spoken about competitive intensity increasing. Have you looked at that point?
Yeah, I mean, we've looked and rejected that space, in fact, for precisely the reasons you mentioned. In this space, there are companies which don't have a significant product edge, because it's not that R&D of one AC manufacturer or one electrical appliance manufacturer is significantly better than the R&D or the product development of another. Most of them are actually third-party contract manufacturing companies. And when it comes to distribution, when it comes to marketing, supply chain, there aren't significant competitive advantages that we've identified, which have allowed companies to maintain dominance along with profitability. So there are some companies which have actually sustained dominance, and dominance by itself is not reflective of pricing power, because if you don't have pricing power, then you can have actually dominance without profitability. And hence, I mean, it's a space where you'll have one or two companies doing well for 2, 3, 4 years, but you can't have a buy and hold and expect to say 20-25% free cash flow compounding over a very long horizon, barring maybe one or two companies which are part of our coverage but not in the holding portfolio. So largely we've avoided this space in the past.
All right, Rakshit, got your point. Thanks so much for joining in and sharing with us your outlook.